From Washington, this is the Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, June 10th. You're listening to the Macrocast, brought to you by Markets Policy Partners and Hamilton Place Strategies. I'm Tony Fratto. I'm in Washington, D.C. today. John Fagan, Brendan Walsh with Markets Policy Partners in the house, as always. Guys, we had a newsy CPI print this morning. All eyes were on it. Like CPI is taking it's taking getting the attention that was only reserved for Jobs Day in the past, and it's eliciting full panel attention on Squawk Box at 8:30 in the morning for review and commentary, and it is a big number. Brendan, why don't you give us a tale of the tape, and we can dive into it a little bit.
Yeah, so it was, people expected it to be high, and it was even higher than expected. So the headline, which includes everything that we buy, from a year ago, people were thinking that it would be up 8.3%. It was up 8.6%. And just from last month, inflation was up a whole percent. Just to kind of put it in simple terms, the average American household earns $70,000 a year. And so compared to a year ago, you're paying $450 more a month for the things that you normally buy. Obviously, a lot of that has to do with what's going on with oil, and that has a lot to do with what's going on in Russia and Ukraine. But nevertheless, people are paying a lot more. But that's not the full story. Also, food is up, but even beyond that, services inflation. So going out to restaurants, going on vacation, those prices are also up. So this number was pretty broad based.
What was the core and top line differentials?
So that's an important point. So on a monthly basis, so core was up a lot. It was up 0.6%, which normally core would be up 0.1 or 0.2% on a monthly basis. And from a year ago, it's up 6%, which is also very, very high.
Expectations were around 0.5%. It doesn't sound, if you're not familiar with the numbers, the difference between 0.6 and 0.5 doesn't sound like a lot, but it's a lot.
But it's a big deal. Yeah. But when you look from about a few months ago, the core, the headline rate, which includes everything, is still going up. The core rate on a year-over-year basis had peaked about 3 months ago. So there is some optimism in this report that maybe we've seen peak inflation on the core front, not necessarily on the headline, because gas prices could keep going up and food prices could keep going up. That very much is related to what happens with the war. But also, it's important to keep in mind that this is May, and we're in June now. And June has provided a number of data points that are somewhat optimistic for the future of the inflationary path. I know we talked offline about it, but a number of companies, Target being the one that kind of got it started, cut their earnings estimates for the coming quarter, because basically they realized they bought way too many. They stockpiled for goods that the consumer had bought in the last 2 years, and now knock on wood, COVID's kind of over, or whether it's over or not, we've decided it's over, and people are returning to the world, and they're spending their money in different places. So goods inflation could be the opposite. We could start seeing good products deflation.
Certainly.
One of the other things that's really gotten lost in the pivot from transitory inflation to inflation fighting, one of the things that used to be a real mainstay of Fed communications was this laser-like focus on their preferred inflation metric, core PCE prices. Well, that to the almost to the exclusion of any other inflationary metric. And when you're talking about the ways in which the Fed has been characterizing inflation, it really has been this monolithic thing. They've been very wary of splitting hairs. They've paid lip service to the supply shock dynamics of some of the price increases. They have made some modest nuanced differentiation between the metrics, but it used to be like, don't even look at CPI. Core PCE prices, core PCE prices, core PCE prices. Now, core PCE prices look bad, right? But they don't look as bad as CPI. And there are reasons for the Fed's preference on this front that you can quibble with. But that's something that has really kind of fallen by the wayside in terms of the communications. We think that will probably reassert itself further into the tightening cycle. The Fed isn't really in a position to be splitting hairs here right now. They're still in catch-up mode, it seems. But we think that is going to come back to the fore in their framing of this as inflation pressures do become more nuanced and core PCE prices look a little bit better than CPI.
Yeah, and John, that's an important point because the big difference between PCE and CPI is the weightings, and CPI puts a much larger weight on housing components, where it's slightly smaller in the PCE. But most importantly, in this May reading, the housing was up a lot. It was up 0.6% on a month over month basis, which is huge. But going back to the more real time data, the housing market's not doing very well.
Yeah, that was kind of a question I was going to have, Brendan. Is like, do I believe that data, or do I believe my lying eyes or my truth telling eyes or something? Right? Like, I mean, we do know that in this just fairly significant large component of the economy, mortgage applications are
we get that on a weekly basis.
Yeah, and they're way down, and the market, if the intention was to cool off a significant market, they did it there. We didn't see the same. We didn't see it, at least in this month, on I think autos were still hot, but surprisingly hot. I thought actually in this right this report.
But another one that we get a real time data in the Manheim index, and that's down precipitously.
Right. Yeah. But this report is showing us the opposite.
Exactly.
Right. So it is like, it's still kind of noisy. I mean, look, I will do my, I don't know. I mean, I think I have to do my Janet Yellen mea culpa on peak inflation. I called peak inflation. So it's apparently not peak. We apparently did not peak yet, but maybe, but boy, just looking forward, looking at around, look out the window and look around at what we see. And, I think we got to, we hear of the struggles of retailers, as you mentioned. We are seeing, probably some cooling in hiring. We're seeing what's happening. Like, it's like blindingly obvious in housing, what is happening.
Yep. Freight rates are down a lot, actually.
Yeah.
So the market, those are all forward-looking. They're not forward-looking. They're real-time data points that show what's coming in the future.
Yeah. All that said, like, I mean, what's the Fed going to do? And, people were thinking 50-50 pause or 50-50 quarter. I think you have to be thinking 50-50 into September. But why wait? Why not go 75, or why not go a full point?
Well, we saw Fed Chair Powell in some of his commentary, like, seeming to rule out 75 basis points as an increment. He didn't really give a lot of color on that. That was obviously a while ago, but he seemed to basically just torpedo 75 basis points. I think that, it sort of flies against their commentary of it seems to like clash with the commentary of expeditious and sort of do whatever it takes to inflation, and he sort of incongruously took 75 basis points off the table. Maybe it comes back in this upcoming meeting. Our expectation is that the Fed is going to say, they're gonna. I don't think this really changes their narrative, because they're not really, aside from a few voices, and we've talked about Atlanta Fed President Bostic, flashing forward to a potential September pause or downshift or that sort of thing. We had Lael Brainerd come out and basically pour cold water all over that and essentially say, let's not talk about that. We're not even close to there yet. And I think that's right. When you look at like this CPI number and the way that the markets reacted to it, what happened to the 10-year Treasury yield? Did it spike up because of terrifying inflation fears? It fell. Obviously equities didn't take it well either. But when you do look at that forward-looking posture, the financial market reaction, and financial markets aren't always right, but the reaction is much more reflecting concern about the Fed's reaction function to the inflation rather than to the inflation itself. That continual theme that the cure is going to be worse than the disease, and that we will get a Fed over tightening. So we did see a major flattening of the Treasury yield curve, which is associated with Fed over tightening fears, growth fears, and that sort of thing. When you look at the other sort of forward-looking indicators, the TIPS break-evens, the market-based gauges of inflation expectations that are embedded in these Treasury protected securities, those, issued your mea culpa about calling a peak in inflation. Well, TIPS have called that peak. Yeah. Right now, anyway. So the TIPS market, looking back at the 5-10 year TIPS, those cycle highs for the 5-year were 3.73%. And for the 10-year, 3% in sort of late March, early April. And they're trading now. The 5-year is at just over 3%. And the 10-year is below 3%. It's 2.77% last time we looked. These are not numbers that are, directly in line with where the Fed's 2% inflation target is, give or take, but they're not that far. and they do really represent a peak, at least for now.
You're telling me to hold my call. Is that what you're saying?
Well, I think that there's you're far from alone in thinking that, these are noisy numbers, let's face it. And I think it is important to note that for CPI anyway, not core PC, but CPI, we've got, before the September meeting for the Fed, which is in late September, we've got June, July, and August readings, right? And Lael Brainerd said, I want to see a string of lower readings. Well, she could still have that string of lower readings going into that September meeting.
That's true. Yeah. Well, we'll look for them. Brendan, you mentioned one of the odd things. I mean, we talked a little bit about it last week. We received more of it this week when Target came out and sort of restated their outlook a little bit. But this, I think it's hard to overstate just how much the supply chain issues have screwed with this economy and just what makes it so difficult. I mean, when if you're thinking about where the Fed ought to be, there's a debate out there about what the terminal rate should be, like where should they end up, and should it be at 4%, should it be 4% or 3.75%? Could have this debate, and there are people who will say, what are you talking about? That's, you're just chasing inflation. You're not snuffing it at that rate if inflation is running as hot as we saw it reported today. But if as Milton Friedman said that his admonition was that inflation is always and everywhere a monetary phenomenon, and I say, yeah, mostly, maybe not always and everywhere. When you've got the guys who are the very best in the history of the planet of moving goods from producers around the globe to your store shelves in ways that are efficient and within super tight margins so that you could have them when you're ready to buy the things that you want, and they are experiencing shortages and gluts on the shelves. That's not a monetary phenomenon.
No, I agree. And
right, it's like that is a weird thing that is screwing with prices up and down.
Yeah, we're almost forgetting that we're still reemerging from a pandemic. This time really is different. It's just very difficult to predict what the world's going to be like in a month. So you had the three, it wasn't just Target, it was Walmart and Amazon, all admitted that they overstocked, and now they have to readjust. You have Jamie Dimon, the CEO of the biggest bank in America, who 2 weeks ago at his investor day said things were fine, and a few days ago said that a hurricane's coming. You just have these examples of in like 2 weeks, people have completely different views of what they thought that the future was going to be. So it just shows just how difficult it is to run a company, let alone to try to then be a policymaker whose job is to predict not just what your company is going to do, but what the entire world is going to do.
I agree. Well, look, I remain in the soft landing camp and the no recession camp. I still do think that the runway is a little bit wider.
And that's a really important point too, because people focus on Target. They cut their margins for a quarter, but they also kept their guidance on how much the consumer was going to spend at Target. It was going to cost them. They were going to make a little less money because they had to readjust their supply because they bought the wrong stuff.
Yep.
And the consumer's buying different stuff at Target, but the consumer is still spending the exact same as they thought at Target. So the consumer is still doing quite well. And that's the risk for the Fed is inflation's terrible. And like I said, it costs $450 more a month. But you know what's even worse is not having a job.
Yeah, exactly.
Yeah, and we do have this situation in which there are indications on the margin that the U.S. consumer is taking on more credit to keep up their spending. They're dipping into savings. Balance sheets are still good, but there's the question, and we're with you, Tony, that the near term, there's enough fortitude in the U.S. consumer, and we think that the Fed is going to be judicious in its tightening cycle later in the year once it's kind of caught up over these next couple of meetings, or caught up to a greater extent over the next couple of meetings. And I think that market conditions and economic conditions are going to not meet them halfway, but facilitate that downshift as growth does. A cyclical slowdown is in evidence in certain areas. It's certainly more forward looking. It is more anecdotal, but we're picking up more and more signs in the data that the U.S. economy is on a down cycle. Is it recessionary? I think the real issue is, this is a different kind of cycle. And if you cast out into 2023 and postulate that our gasoline price is still at like $5 a gallon, way out there, is the global food price shock actually worsening between now and then? Yeah. And that's where you get into the concerns about whether, the U.S. consumer just takes too many body blows, and that sort of war of attrition with the supply shock price dynamics eventually creates a real retrenchment in spending.
Indeed. Well, hey, let's. I want to take a break here, and then I want to come back and talk about another story that we haven't talked about, the land of the rising sun, in a while. We're going to talk about Japan, and Japan with 20-year lows in yen dollar cross and the yen dollar pair. And I want to come back and talk about Japan. You're listening to the Macrocast.
Check out HPS Insights, a regular podcast from Hamilton Place Strategies, bringing you the latest on policy debates affecting the business and political communities. Available on the HPS podcast channel on your favorite streaming platforms, including Apple, Spotify, and Google. Tune in to the latest episodes and learn more at hamiltonplacestrategies.com/podcast.
Back on the Macrocast. And John, I know you wrote about this as well, but it's there's not a lot of foreign news that's breaking through with all the news going on in the United States these days. But Japan dollar, really has, and it has, the dollar yen has been in a, I want to say a modest range for quite a while. Until recently, and if we had a chart, you could see it. But the yen has taken a pretty steep dive. Recently, I think you tell me what the percent drop is. I mean, I think at last I saw was around. Around one. Where are we on it? 130.
We're knocking on the door of 135, which is about a 20-year low. And if it goes, if it sort of crosses that threshold, then we're going to be back in 1998. I used to live in Japan a long time ago. I actually left in 1997. And so some of these dollar yen levels are making me a little nostalgic.
I remember, I remember traveling to Japan in the early 2000s with it in that 135 range. And it's been so it's kind of shocking to see it back there again.
Yeah, there are a variety of different things that are surprising and eye-catching. Obviously, the multi-decade levels, weakest level in so many decades, that's always going to get your headlines. Also, the speed with which it got there, it's been pretty abrupt. The yen sort of gave up very quickly. And it also is happening in a way that is unusual based on recent experience. And by recent, really, in the post-global financial crisis and even before kind of era, when you had pronounced market volatility around the world, the yen would tend to strengthen, even against the dollar. Yep. There was always this sense that it was a weird safe haven trade because the yen, the fundamentals behind it don't look particularly attractive, but it really was the dynamic of having so much foreign investment by Japanese institutions and individuals that becomes a repatriation source when the global financial conditions begin to worsen. And so that repatriation was always a major aspect that allowed the yen to, really would put the yen in a much stronger footing during times of market turmoil. Well, we've had plenty of volatility and turmoil, and the yen has not been performing that way. And so it is a bit of, not only is it weakening, but it's weakening under conditions that tell you that something has changed. One of the other things that has changed, obviously, has been the coordination, almost the unspoken coordination between central banks. One of the things that's kept currency volatility very low in the post-global financial crisis era has been this mirroring behavior. we termed it the mirror conspiracy after it's an old album, but it was central banks essentially in a globally low inflation environment can essentially just draft off the Fed. If the Fed does one thing, the other global central banks can do it as well in a mirroring kind of way and keep FX volatility low. This current inflationary situation around the world is not evenly distributed. We'll talk a little bit about that. And it's created a massive divergence between the Federal Reserve and the Bank of Japan. And that really is a major factor behind this. And next week, we've got, drum roll please, both the Bank of Japan and a Federal Reserve meeting. So it is going to be, that divergence is going to be right in the spotlight.
And the divergence, part of it, really is policy on the side of the Japanese, right? Kuroda is practicing, yield control, capping the long end, and while we're raising rates, right? So we'll see that in relief again next week with. He is signaling that they don't intend to. They do not intend to tighten, and the Fed has signaled they absolutely intend to tighten by 50 basis points. Yep. So the divergence is baked in, right? As far as from what I could tell, and like I said, we're just. I don't know. I think Kuroda has been pretty explicit that they're not raising rates.
Oh yeah, that's right. Now Kuroda. To roll the tape back to 2016, Kuroda can throw a curveball. He told everybody that would listen for years that negative interest rates were not appropriate for Japan. And then he cut interest rates negative in early 2016.
That's true.
There was a huge shock about a volatility. Eventually it washed out, but it did not create the kind of, at least initially, the kind of market dynamics you would want to see. The banks sold off heavily. The yen actually rallied. The whole thing was a bit of a shock. So he has in his recent past surprised financial markets, taking them off by surprise. We don't expect that to happen. We think that he means what he says. That they are keeping their interest rates, negative interest rates, and yield curve control with that 0% target for the 10-year yield as the rest of the global 10-year sovereign yield complex shoots higher in yields. That's that widening divergence. And that really drives the currency. But, why is Kuroda so fixated on keeping this? One of the reasons is when you look at, I had to go back and I said this, I had to go back and double check Japan's CPI. The last CPI reading that came through was it soared to 2.5%. And that's the headline. Core is 2.1%. The Bank of Japan's forecast for this year, for 2022, the average inflation is 1.9%. Their expectation for next year is that it falls to 1.1% for the ensuing 2 years after that. That is not compatible with what the Bank of Japan's inflation target is. Yeah. They have their own models have them missing on the downside persistently. And this comes after a very long period. I mean, Japan has been the poster child for secular stagnation for years and years. And, the idea that Governor Kuroda came in under the banner of Abenomics, almost 10 years ago, when it was time to change the game, to reflate Japan. And this is the last year of his 10-year term. And one might suspect that this is, if anybody is in a position to persist with this, it really is Governor Kuroda. I mean, he has not, he's not succeeded in getting that persistent reflationary aspect. And maybe this is it. Why would he snatch defeat from the jaws of victory if he's not forced to do so and start tightening? They've shown a lot of control, obviously, over the yield curve, that they've been tested, but they seem to be holding the line. And the yen is sort of the pressure valve. And right now, we've seen some pretty mealy-mouthed expressions of support from the Japanese officials. Usually they'd be coming out and just chattering about the yen endlessly. They'd be engaging in a dialogue on the weakness and warning on it. Kuroda barely even spoke about it in his remarks earlier this week. And, we got a meeting, the announcement of a meeting overnight between the Japan's financial regulatory, the Bank of Japan, and the Ministry of Finance. And they came out with a statement saying, Japan, the yen's been moving too fast, and we have some options to deal with that. That's not complaining about the level. That's complaining about the speed. And, just the fact that they've come out, they've waited so long to say anything, it shows a degree of comfort with this, with the current level. And they've got the fact that they haven't even talked about specific options for intervention or countermeasures or anything. They have a lot more other tools to pull out of the toolbox. And so,
I would say there was a
totally different kind of reaction function.
Yeah, for sure. But certainly when you were living there, and certainly when I was traveling there more regularly, the conspiracy would have been that, is merely, Japan reverting to its, export model of, weak yen to juice exports. I don't think that's the case today. I mean, I think it's that economy is a little bit more balanced. Even their exporters have diversified production. This is always the argument from U.S. automakers that the Japanese automakers were, benefiting from the weak yen to compete against American automakers. But they've diversified production so much everywhere, including, I think, I have to go look at the numbers. I think Toyota, a client of HPS, I think Toyota makes more cars in the United States than it does in Japan today. So it's certainly not.
Right. Yeah. And the imported inflation, obviously, anybody that's been in Japan knows that food and fuel on a good day are really expensive.
Exactly.
And so there's a lot of other stuff sort of baked in there, the taxes and that sort of thing. The government under the new prime minister is, or the relatively newly minted prime minister is, they're giving out gas vouchers and that sort of thing but it's just not that as intense an energy economy. It's not as intense a carbon economy as you don't see a lot of big F-150s rolling around the streets of Japan.
Let's be clear. You don't see giant F-150s or 250s anywhere in the world except in the United States. This is the market. This is the market for them. The only thing you see, you can go to, I've been to 50 countries around the world, and you see pickup trucks. They're driven by construction workers and landscapers and the bad guys who mount guns on the backs of them.
So our view on the yen is that the jawboning continues. Obviously, it's sort of it had some effect today, but the biggest effect will be whether the 10-year yield differential calms down. And we've seen the 10-year yield in the U.S. gyrate a little bit here, but it's had a tough time getting above 3%. And for sort of this this self-defeating almost dynamic in longer term treasury yields, which is the further they rise, the more risk aversion occurs in the risk asset complex, which tends to drive demand for longer dated treasuries, and then begins to sort of cap the upside. We've seen that dynamic play again and again. And to the extent that over the next few months, we do see that cyclical slowdown manifesting more clearly in US economics, we get to see, if not at the end of the summer, then into fall, the Fed beginning to adopt a more balanced kind of approach, the risk balance between growth and inflation becoming a little bit less skewed toward inflation. And I think that that's the kind of thing that the Japanese officials are kind of, battling a rearguard action, waiting for those conditions to help stabilize the currency before they really have to, be called upon to intervene.
Yeah, I think I think it's the right place for them to be right now, given where they are.
Well, I mean, when you look at there are the awakening the ghosts of the Asian financial crisis. There are commentators that are always going to be doing that as soon as you link like 98 Japan and that sort of stuff. It's a very different world now. The idea that you would get in competitive devaluation around Asia to try to keep up with the weakness of the yen, that just doesn't seem like the likely dynamic now, especially since China is so dominant. Look where China was in 1998, right? In this picture, it wasn't really factoring in that much to the extent that it is today. And the Chinese economy is a completely different animal. And so, the idea that Beijing would allow their currency to spiral downward in an effort to keep up with the Japanese economy, that just doesn't wash. And we think that the renminbi has had most of its weakness already come through. They're stimulating the economy. That should help over the coming quarters, the growth picture. And we think that feeds through to the renminbi and Chinese assets in general.
It'll be interesting to watch. I'll be paying attention to comments next week and just see where it goes from here too. It really would be remarkable if it falls, significantly further from here. Brendan, what are we looking at next week?
So on the data front, we get the U.S. retail sales for May, but it's a very busy week for global central banks. So the Fed has a meeting and now has a little more information to make their decision. The Bank of Japan has a meeting, and also the Bank of England.
Yeah, the European Central Bank had their meeting this week, sort of kicking off, and it was a little bit of a Rorschach test. They did kind of what everybody expected, which was signaling a rate hike at the July meeting, holding fire for now. But, the idea that they might have to go faster down the road after a couple of initial rate hikes and that sort of thing. The financial market reaction is not what you would want if you were sitting at the ECB. The euro weakened, European equities fell, and peripheral bonds sold off. And you got the spread in Italy, the German-Italy spread, which is a classic stress indicator in the Eurozone, widening out in a way that was not particularly helpful for risk sentiment. And the European Central Bank has just got a much higher degree of difficulty here with its monetary situation, it being, so much closer to the situation in Ukraine, with energy being used as a weapon against its economies and the whole. They are in a really tough spot, and the markets didn't like what they heard earlier this week, but it's not clear what they would have liked.
You actually reminded me of just an important question on this. So you're right. So euro weekend, we just talked about yen weakness. So dollar strength. How much are you thinking about dollar strength overall in like where would we be with a weaker dollar right now on the inflation gauge, right? I mean, it is helping the Fed do its work right now, right?
Yeah, it surely is. Yeah, usually you don't see oil prices and the dollar going up in tandem. That's very rare. And so this is a dynamic that's very challenging for emerging markets, and particularly like the oil dependent ones. It's a situation where the broad dollar index is off its strongest level from early last month, and but it's definitely well supported by Fed hawkishness. Yeah, but moves have been in general orderly. When you're looking at like the volatility, even of the yen, big moves in the yen, the volatility indexes are elevated, but they're far from the sort of spiky crisis disorderly levels, and that's a huge distinction if you're in a policymaker's seat. Orderly and that's obviously pace and that gappy panicky price action. We're not seeing really so much evidence of that.
Not at all. I think it's been pretty. I think all the markets have actually performed really well. And even look, I know that the slowdown in housing was pretty swift, but I think it all has been. Or like this doesn't have a 2007, 2008 feel.
No, it's not disorderly at all. And inventory is going up, but back to sustainable levels. We just had no inventory. So
right.
We still need to build a lot more houses than what we have.
When you do see some of these situations in the markets, like we've seen, very popular, like the Cathie Wood's ARC innovation stock, that was, and the dismal performance that has put forward over the past year plus, really, and the tech stocks falling apart, big, huge hedge funds posting gigantic losses, but it's not knocking over the bank. It doesn't have this daisy chain of, at least not yet, this daisy chain of risk aversion, because the U.S. banks are so solid, and the risk management process allows big hedge fund losses to, at least so far, be kind of like a crumple zone. It's, big institutions that can afford to lose, and have managed their risks. At least, the investors have managed their risks appropriately, even if not every individual hedge fund has. Those funds are posting significant losses, but they aren't turning into this, LTCM domino scene. You can't rule anything out as if volatility continues, and but at least
but
so
you're
far,
right. It's an important point, because people keep comparing this to the housing crisis and the .com. The housing market got a little frothy. It needed to be corrected.
Yeah.
The tech sector got a little frothy, but the difference is in 2000 you owned stocks that didn't make any money, that went down 100% and they went out of business. Now you own stocks that are down 50, 60, even 70%, but they're still viable businesses. They were just massively overvalued, and we're having that correction. And whatever, Zoom got a little frothy, but we're on Zoom right now. It's still a very good company.
Yeah, exactly. And look, I mean, if where there was sort of investment overhang, it was that, right? It was in risk assets like equities. It was in risk assets like crypto assets.
Yeah, crypto is the example where you did lose all your money in certain.
You can lose. I mean, you lose a lot of money though, right? But when you think of like the sort of long-term impact of that, I mean, a lot of that was. I don't want to. People some people made poor decisions in all of these areas, right? I don't want to call somebody stupid for buying Bitcoin at 50 and give a pass to somebody who bought Netflix at 700.
Yeah.
Right?
Yeah.
Like just that both were not wise forward-looking.
And I would so Bitcoin, down a lot.
Yeah,
but it's still worth $30,000. The NFT, that kind of market got a little frothy.
Yeah. By the way,
like a monkey.
Yeah, Bitcoin's performing better than Netflix. By the way, so
it is. Yeah.
Right.
So crypto encapsulates a huge amount of.
My point is though, I would we're not seeing like it is better and more manageable than seeing tracts of
Yes.
homes in the Las Vegas desert, empty, or seeing condo towers in Fort Lauderdale with 500 units and 3 residents, right?
Exactly.
Like that's what we were looking
That's not what's happening now.
2009, 2008, and that's not what we're talking about here. This is, this is manageable.
And even the people that think we're going to recession kind of think it'll be a relatively mild recession. The risk is that the Fed over tightens, not that the economy is so out of balance that we have to spend years working our way through this.
Yeah. All right, guys. Interesting stuff this week. We have a lot to look forward next week. And I love a big central bank week. It's one of my favorites. I think I like big central bank week even more than jobs day, to be honest with
you. No offense to Matt McDonald.
No offense to Matt McDonald. I love to see the major banks. I love to hear from them. All right, guys, have a fantastic weekend.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.